What have I told you since the first day you stepped into my office? There are three ways to make a living in this business: be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
Getting ready for the new month, but before that, wrapping up the month of February. So, welcome back for another weekly market recap. Quite an interesting week. A lot of macro data coming in. And of course, the icing on the cake was Friday meeting in the Oval Office in Washington. Uh, I must say, interesting. It took us just decades, but now you know how business are conducted when it comes down to geopolitics and these crazy politicians. Do you remember last week I started out the video saying prepare for madness? Well, maybe we're not prepared enough for the madness which is gonna come. I don't know. That was quite hilarious. I know it's very polarizing, so I'm not gonna dig into it because I don't feel like this is my role, right? To try to talk to people about political shit. It's just a waste of time, in my opinion. Although I do with people I know, but as for the rest, who the fuck cares? You see, the nice thing about it is that you are entitled of your own opinion, whatever the fuck it is. So be happy about it. Now, let's have a look at the economic calendar. I shifted from Forex Factory back to my FX book, kind of getting back to the origins when I was mainly trading FX. The reason being is, although I do like Forex Factory and it gives you the possibility to just expand the chart for the macro data you're looking at right on the calendar, but it's very limited when it comes down to the numbers of data points which brings in, although you set up the calendar itself to bring in the medium and high impact news. Like my FX book, it's a bit more detailed when it comes down to it. So this week I was sticking to it. So again, last Sunday, German elections results. I don't know. I mean, again, don't want to dig into it. It looks like the far right actually gained some traction. Why? Who knows? I don't know. I'm not German. I really struggle to get my own politicians, let alone what's going on in other parts of the world. Uh, Maybe, I mean, if you really point a gun at my head, I'd say, it might be that people are a bit tired and they're just trying to vote out whoever was in charge because things are not working out well. And at this point, you feel like no matter who comes next, it's not going to be worse than this. So let's just try to change it. Will it work? Will it not work? I don't know. But, that's the double sword of democracy. It's a little bit of a double sword, right? If you think about it. you know. But enough bullshit. Let's try to focus on the actual data. So the national activity index ticked down a bit. Not so cool. The conference board consumer confidence that went way down. That was a bit of a surprise for markets. So consumers, if you check the sentiment, looks like it's not so good anymore. But nice piece of data nonetheless. We're gonna get back to it in a minute. Again, consumer confidence in Germany down, of course. New home sales in the US, ticking down a bit. But at the same time, Case Shiller home prices went up. So what? Home prices is going up, but home sales are going down. It might be sales are going down while prices are going up because people just can't afford those prices. I don't know, just an idea. What else? Just trying to scroll real quick. Initial jobless claims came in hotter than expected. And although I've always like Yeah, I mean, they're still in this range. Well, I mean, yeah, but it is also true, truth be told, that if you look at the 4 weeks average, now you see that basically it's going up a little bit. It's it is still in this range, to be fair, but I guess the most interesting data is this one, the continuing jobless claims. So that means how many people are going on the unemployment line and then getting stuck there, so not being able to find a new job, presumably. And this one, it's really going to the upside, starting in September 2022. So not cool for the labor market, no matter what Powell said. I mean, actually, Powell said that the labor market is great for those who already have a job. If you don't have it, shame on you. You're in big trouble, right? He actually said that at the conference. Would you believe that? What else? GDP came in at 2.3. Previous read was 3.1. But I mean, it just met expectations. If you remember, it was maybe 2 months ago. We were saying it's unrealistic GDP. It's going to be above 3% for the US at the end of the year 2024. You're going to see a lot of revisions, adjustments, and whatnot. Probably the more realistic number would be around 2%. Well, kind of. It looks like we got closer to 2% rather than 3. So another good one. So what else? I'm just trying to stick to the most relevant ones. Employment rate in Germany, 6.2. Again, if you pair it up with the consumer confidence, not cool. I don't know if I just skipped it, but consumer confidence in Germany, it's really showing negative prints. So again, Germany, the Eurozone, not cool. The economy, it's not really performing. What do we got then? Let's get to I guess it was the most anticipated economic data for the week, the PCE. So PCE came in at what? Not zero point 0.3. The core, again, not zero point 0.3, same. So not a big surprise there, I'd say. We're still relatively stable. What's strange is personal income went up by 50 basis points compared to the previous read, but at the same time, personal spending went down like a lot. 10 basis points compared to the previous read, came in 30 basis points if you check the consensus. Hmm. Isn't it strange? Like consumer confidence, the conference board consumer confidence is going down, a surprise to the downside. Personal income is going up, studying to these, but people are spending less. It might be that even, I mean, assuming they're making more money, but they are saving more rather than spending because they're not confident the economy is going to be fantastic over the next few months. Who knows? But I guess that would be what the numbers are suggesting. Anyway, enough of that. Let's get into the charts. Let's try to be quick with currencies as usual. So the XY bounced. It came in not really at, but around the range high of the macro range we always look at, and it bounced to the upside. Guess you might take it as a normal backfill. You got a little bit of inefficient leg in here. We'll see if this move can be sustained over, the month of March. The euro conversely came down. Uh, would you want to add, it was already kind of at resistance. You put the announcement of tariffs on the EU on top of it, and you got a sharp move to the downside. That's for the euro. That would be a narrative I would buy into, to be honest. The pound, same, came back down a bit, relatively stronger than the euro, and we keep on seeing this. So again, I didn't solve that equation yet, why people would prefer the pound rather than the euro. I think I'm getting there, but I'll disclose it a bit farther down the road, I guess. Japanese yen pulling back, ending up the week, and again the fear of the yen carry trade unwinding. Don't think that's why a lot of risk on assets actually came down this week. It's the rate of change. It's not necessarily the direction alone. All right. Canada. So the loonie, well, it was a sharp drop for the loonie. Stalled a little bit around this resistance and finally was crashed. Well, in relative terms. Could this be because I was reading, if you remember, the US government came up with tariffs on Canada and Mexico. Then tariffs were postponed of about 30 days, assuming Canada and Mexico were implementing some measurements to prevent immigration and the fentanyl coming into the US. So, taking care of the border. Uh, I'm not sure if I'm right or wrong. I think it was just something I read randomly, but it looks like the reports that Canada brought to the US weren't particularly satisfying for the US. So they just said, no, that's not enough. You're not doing enough. So, yeah, tariffs are going to hit at the term we gave to it. I mean, we gave you 30 days more, but it doesn't look to us like you're actually doing something in that direction. So yeah, tariffs on you. Could this be why the loonie actually pulled back like a lot? Maybe. I mean, currencies they're usually influenced by these sort of things, so it could be. As for the BRICS, or at least for them, um, nothing really special. I mean, the Indian rupee, it's still as weak as it was, just a bounce and then faded. Uh, Chinese yuan is moving in a range-bound environment for now. The ruble, what's gonna do? Finally hit in resistance. Would you call it a bit of exhaustion with this shooting star candle? Maybe, but it is also true. You would need to assess it in the sense, yeah, but it's getting back down into the previous shelf, which was built up on the way up. Would you expect at least a bounce in here and then we'll see? I mean, or at least up until the point we can break it and getting back below it. It's not really a confirmed reversal. Yeah, I think I'd be a bit neutral on it. And the Brazilian Real, it had that relief rally. It looks like the rally's been faded now. So not a lot of news as for the BRICS. Same as oil, right? On oil, not a lot of surprises. If you remember, we were saying probably oil is going to grind to the downside. It looks like that's what we got. We opened up the week in here, already below this level, right? Because the open is here. Tried to rally, get back into previous resistance, and it was just rejected. And found support where, well, again, the level which was highlighted before. And then for the rest of the week, we traded into this range and we closed down the week in the middle of the range. So again, not not really seeing a lot of new things on oil. I think it's still the same stuff, slowly grinding to the upside. And again, you always know that it just takes a little bit of news to get and to generate some sharp movements like these. So just be aware of it. But overall, if you don't get news getting in the way, I think fundamentally the path for oil should be still to the downside. Now we'll see how much. I mean, in that case, assuming it's going to keep on going to the downside, we'll see how much it takes to break this level and trying to target these lows. Could be a week, could be a month, who knows? We'll see. As for the rest, a bit more short-term bullishness. If you can now reclaim this level and stay above it, then we might talk about a retest of this fractal right here or around the previous highs. But other than that, I'm not expecting a huge expansion in oil one way or the other. Bitcoin, Bitcoin finally broke down. I think I've been guilty on Bitcoin in a sense. Like, if you remember, I ended up the video last week saying, I don't have a clear idea. I think I'm not seeing anything on this chart. But, if I think back to it, I've always said, I see Bitcoin kind of like a risk on asset, so it should be correlated to equities, right? But in that same video, when I was talking about equities, I was like, you know what? This down move, it might have legs behind it, so don't be surprised if you see a bit more weakness. So again, following my own logic, if I was to be, complete as for the informations provided, I would have had said, yeah, probably the Bitcoin chart, it's not providing me a lot of insights, but if I run off the assumption it's going to follow what the stock market will do, I would be much more bearish onto it. Uh, I just lacked that last step, I guess. Didn't make the connection apparently, so shame on me. That was a pity. I mean, would have been nice, right? Just to have the ability to come back now and say I called it, which again it doesn't really count shit to be fair. But yeah, anyway, it's just for the entertainment, right? If you check the futures, is it just a gap fill? I know people go crazy about gaps. So what's going to do now? The gap field reacted particularly well. Are we in for a bounce throughout next week? You tend, in my experience, you tend to see uh, a little bit of a move when you start out a new month. It's like, people trying to position themselves one way or the other. And that was true when I was trading FX. And I've seen it's relatively true now that I'm trading indices. So look, I wouldn't be surprised if we see Bitcoin trying to put together a bounce. Although that being said, at this point, I can't really be bullish on Bitcoin long term up until the point it is trading below this area right here. Which I know it sounds like saying, yeah, no shit, Sherlock. If it goes above the previous dealing range at this point, it would be already above 100K. So, you know, the low was here and you're saying it's bullish now. Well, what are you going to do? That's what I do. I don't necessarily aim at buying the ultimate lows or selling the ultimate highs. I I would prefer to buy something which has a bit of momentum and a clear and defined structure one way or the other. So by that logic, at this point, I should have a bearish disposition on Bitcoin. And I think although we fill the gap on the CME, but we might have a bit more of a room to go to completely fill in this inefficient leg. And overall, the macro picture, it's not so rosy. And Bitcoin is the king of risk on assets. I might say I should retain a bit of caution on Bitcoin and saying I need to see something substantial in order to say, yeah, well, I would buy it with my own money, which for the moment I wouldn't. And again, uh, you can call me stupid. You didn't buy the lows. Yeah, I will never buy the lows in anything, basically. So, yeah, I'm really aware of the situation and I'm prepared to accept the consequences of it. Absolutely. All right, let's move on to gold. Interesting week for gold. If you remember last week, we were like, yeah, the pullback, it wasn't really that sharp, but that doesn't mean that it cannot come next week. Guess what? It came. And again, if you remember 2 weeks ago, we were talking about this area. It's a bit of a front run of big figure, 3K, round number, psychological level. It's not unusual for the market to front run it. Well, it looks like we did eventually. We tapped into it a bit more, like one, two, three, four times, and eventually we pulled back. What was the target we were discussing next week for the pullback? If you remember, I wouldn't be surprised if we see it getting back into the 2800, 2700. For now, we just hit kind of like in the mid 800. So now the question becomes, uh, can we hold Friday's lows and reaccumulating, defending the lows? Because at that point, if you see it starting grinding to the upside, I might say, you know what, one, two, three, four tests into this area. I guess next time if we approach it, we might break it. Otherwise, I mean, if you see the low on Friday, put in on Friday being violated and price maybe closing below this level and starting to crack into the shelf, at that point we might discuss lower targets like 2,800 even, or even as well 2000, mid 2700. It's a good area. Not only you got this shelf, which you could identify like a little bit of a breakout tag, because look, the market comes back down, it reaccumulates, and then on the breakout it actually gaps up, breaking to the upside. So very strong move. And at that point, I would expect if the market gets back into the level and kind of tap into this gap, I would expect a little bit of a strong reaction there, to be quite honest. And the invalidation is pretty easy. Like, there is a gap, there is a shelf. If we don't get a strong reaction here, or if the reaction is really mild and it's quickly faded and it starts to grind toward the middle of the breakout tag of shelf, in this case, uh, then I would start to be much more bearish. But for now, as I said, next week, up until the point we pull back into this level or this level, I'm not majorly worried. Uh, that being said, if you remember, again, 2 weeks ago, I guess, when I said that this one right here, that's not a bad level to take profit at. Just give it a few days, but eventually things tend to play out more often than not. And again, I'm not saying I knew it, I'm not saying it was a given. It's just, again, on a probabilistic terms, right? If you check price behavior, if you try to follow assets and see how they move, over time, it just comes a bit more natural to develop a little bit of a gut feeling for what price may or may not do, or what is more realistic to expect from price action, going forward. And again, it might just be I was completely lucky on this one. Who knows? Sometimes, being lucky is better than being good, I guess. So enough of that. Just a quick pause before I hit on the equity market and the usual yields and bonds and whatnot. Uh, First, I got a few things to do before that, and secondly, I'm running a bit short on time, so I'm gonna just pause here and resume later, and then I'm gonna edit and kind of you know bind it all together and editing all together, right? So just I mean, at the end of it, it's gonna be what, 5 seconds for you, probably 2 hours for me, but we'll get to stocks in a few. As for the equity market, now, if you remember, I guess it was 2 weeks back, we were looking at volatility and the relationship in between the VIX and the stock market. referring to the benchmark, so the S&P, right? Now, if we check a little bit deeper, just out of curiosity, right? I got this one on the screen, and I marked off the 20, more or less, the 20 level on the VIX, and I was looking at what happened when we approached or we went above that level, right? So in this case, for instance, in here, it was October 2023. We get around it and we got a 5%, 5.4% decline. Later on, we get above it and we got another almost 7%. Let's call it 6.5%, rounding the numbers. As for the decline in the S&P, then when was it? Around April 2024, the VIX got back around 18, 19, and we have a 5% decline. Then we got to August 2024 with the yen carry trade blowing up. And at that point, the VIX, of course, shoots really, really high, although for a very short period of time, but it gets up to what? Can't even see it on the chart. 38, 39, and you have an 80% decline, right? Roughly speaking. And again, a few weeks later, around the end of August, another 4.5% decline, while the VIX, it's getting above the 20 threshold. So, I mean, I'm not going to read all of them, but you can see the relationship there in between volatility and the drawdowns on the S&P. So this is just one of the risks that you need to address while navigating these markets. I know in the past we went through a few more than these, like we were looking at, for instance, the seasonality, and we were looking at what happens historically after the inauguration. So you have a little bit of a run up into the elections, and after the results of because of the euphoria of the optimism that everything is going to change around and we are going to be much better off with this new administration which is about to come in, and then at the inauguration it's a little bit of that sell the news event, right? So you tend to have a bit of weakness right uh, after inauguration. And if you remember, inauguration was around the what was January the 20th. So then if you remember what happened in the stock market over the last month, you see the relationship there. Um, of course, throughout all these dumps and mini dumps, what we've seen is retailers, they actually stepped in and they bought the dip. And I remember I was using NVIDIA as a proxy to show this phenomenon. At the same time, the retail investor was maintaining a high level of sentiment, therefore confidence. And we checked something like what was that? The margin debt and the free cash balances. And we see the huge amount of margin debts which were being put on throughout this period. And again, many different other things like valuations being particularly high. And although a few estimates were revised a bit lower, still they were trending well above historical norms. And now we've seen that a few companies here and there are starting to miss earnings, like for Amazon or Google or Walmart, or they start to change the guidance. And the last piece of the story is Nvidia, which actually has beaten revenues and expectations on revenues, but no, it wasn't so stellar. It wasn't such a huge beat, or at least it wasn't enough for the market. This is the perverse thing with markets. They always expect more, and if you can't deliver that, they're gonna punish the stock. Moreover, we've seen that throughout all this period, this smart money, so-called, like the Buffetts, the Bezos, the Jamie Dimon, they were all selling stocks, and we were using the stockpile that Buffett it's building up while he's dumping stocks and going into cash. which was strange, right? I mean, he wrote their annual letter that he always writes that every single year, and it was that period, right? That sentence where he was like, "I would much prefer to be in equities because that's what I do historically prefer." All right, but on the other hand, you are sitting on a 350 billions in cash. So I mean, if you would prefer to do one thing, but you're doing the other, the only logical explanation is that you don't see the risk reward in actually being in equities right now. So again, many different risks, many different signs that something could could potentially change. And if we get back to this week price action, we've seen a bit, I mean, a decent weakness into stocks. So looking at the four indices as usual, you see that the weakest of the pack, as usual, is always the Russell. Okay. Instead, if you check the Dow and you compare it to the Nasdaq, well, it looks like the Dow, all in all, at least in this recent segment, is holding up relatively better than the Nasdaq if you look at the overall market structure. Now, in the grand scheme of things, if you zoom out enough, the Nasdaq it's still a better performer than the Dow. But just recent price action, let's call it the last 10 trading days, maybe. You might even say that the Dow is holding up a bit better, right? You just look at these last five candles, for instance, after the huge drop. You see this week, the Dow didn't collapse as the Nasdaq did. And instead, the S&P right now, it's the one which is holding up better than anyone else. For instance, if you check the low which was put in on January the 13th, the Nasdaq took it out, and ES or the S&P didn't. So that's relative strength on ES right there relative to the Nasdaq. So that would be one thing. And overall, you could still say ES, or again, I'm using interchangeably ES or a SPY as for the ETF, but it's always to refer to the same type of market. I know the instruments are different, but just bear with me, okay? So you could say the S&P it's staying in this dealing range, while the Nasdaq it looks a bit weaker, right? So now the problem is overall, although we have seen the seasonality playing out for February, I guess at this point, if you check the average, and again, we're just talking statistics, we're just talking seasonality, so it doesn't have to be every single year, but you see that overall, March, it's not a bad month, right? It tends to average a 1% return, and it was positive 65% of the time. If you check data getting back to the 60s, I guess. So, it's not that big of a deal. Um, you might expect March to be, I'm not going to say we're going to trade at new highs, but maybe we will try to put together a bounce, or at least to try to stabilize price action instead of keep on plunging to the downside. That would be my take on it. Again, I I still struggle a lot to see these market completely melting to the downside, especially after this spike in volatility, as we've seen in the previous chart. They tend to be short-lived, and they are continuously brought back down. And you've seen many different option traders, as soon as you got a volatility spike, they are all there buying puts on the VIX or selling calls. Although I mean, I wouldn't sell calls on the VIX when you got the spike, because you never know when the spike is going to end. But I mean, maybe buying puts would be a much safer way to play it. Then I don't really trade options, so I'm not qualified to speak on it. Before we go, as for the VIX, it's maintaining itself relatively higher than what we were used to in 2024. And if you try to highlight this range, which is coming from the middle 2024, you've seen that getting into the end of the year, as for 2024 again, volatility increased. Then we got a sharp decline around November, December 2024. It got back up starting out the new year, and now it just settled at a higher levels compared to the previous one. And it looks like now it's going along this uh, rising trend line right here. So we are just confirming the thesis that 2025, we are more than 2 months in now, and for now, yeah, volatility is a bit higher compared to previous periods. So just bear in mind that it might be spicy a little bit. Okay. Now, checking the different layout, at the end of it, if you measure from the weekly open to the weekly close, what you see is that at the end of the day, SPY, and now we're checking the ETFs again interchangeably, yada yada. But the market at the end of it just closed the week 1.30% lower than where it opened up the week. The Nasdaq, again, as showed before, different type of strength, or in this case, the Nasdaq is weaker. So the Qs closed the week down almost 4%, 3.70, 73, something like it. So again, a bit more weakness in the Qs. Uh, Listen, the thing I see here is a bit. It's a little bit of a hit and miss the way I see it, because on one side I might say, you know what, first of all, when you see the market being particularly extended one way, like we have seen in this case, 1, 2, 3, 4, 5 days of just selling, and you see it breaking moving averages like it's doing right now, it tends to have a little bit of a stitch up. Uh, Even if you think, all right, let's assume for a moment you think this is the start of a bear market, right? If you day trade, don't discard the fact that even throughout bear markets, you might have very sharp and sudden pullbacks to the upside. And it's not uncommon if you see these moving averages starting to cross to the downside, if you see price action being pulled into the cross and then sharply rejected, and they, at that point, the moving averages, they actually cross, that's your best bearish setup that you could ask for. Again, just pay attention, because we were almost there, if you remember, in here, middle of January, and price action just pumped, avoiding the cross at the very last moment. So although we have gone through uh, two bearish weeks, just hold your horses a little bit if you are massively bearish, because you might get something else coming. I'm just highlighting a potential risk, because it's particularly easy in this market to have your bias completely shifting around and then being caught on the wrong side of the market. All right, so just try to put together all the different and possible scenarios, because you never know. I always get back to it. Reacting is way better than predicting. All right. So in this case, I would use, again, caution. Um, well, the futures are actually showing the same type of behavior. Oh, I just remember I still got that pattern that I was highlighting last week. Um, if you go by the quote unquote traditional way of estimating the measure move after a pattern is broken, if you check ES, you might even say we hit the target. If you check NQ, we might have something more to give as for the downside move, but you know, at the end of it, these two should be particularly correlated one to each other. But on the other side, you just assume that NQ is currently weaker than ES. So what's going to be? What do you think it's going to be? That is another assessment you would have to make. I, Unfortunately, I don't know. I honestly don't have a lot to say on it. I getting into next week, I think my assessment would be particularly easy. And I think I might be able to kind of, quote unquote, again, grasp what the next week of trading might be by just looking at these. I'm going to show you what I mean. So these are NQE mini, uh, S&P mini, and the Dow futures, right? If you check what happened over the last 2 days of trading, you see the sharp drop on a Friday. And while we are getting down, I hope you can pick it up because I don't know if there is enough definition. Let's try to zoom in. While we broke down on a Thursday, you see that this move is particularly sharp and impulsive and is very inefficient. And if you look at the volumes, there wasn't a lot which was put in throughout this dump right here, which is valid for pretty much all of them. Then, if you check what happened, basically in the last, 2 hours of Friday, we got a very sharp bounce closing down the week. And again, these sharp bounce, it sees the same type of print when it comes down to the volume profile. So there's not a lot of volume which was put in this bump, right? Or this bounce, sorry. So I think what's going to be, first of all, I just think that this bounce, it just rebalanced out all this inefficient move, or at least a good chunk of it. You see, let's say NQ got back where the volumes start to be a bit thicker. Same for yes. Yes actually went a bit higher than that, getting back almost to the previous daily point of control. Although again, yes, relatively stronger, so a bit more of upside for yes right now. So I think getting into Monday, I think again, it's just what, let's say some sort of a plan, like if these then that. So I would say if Monday opens up and throughout all day, it doesn't particularly matter to me as for now if it's gonna happen in London or if it's gonna happen in New York. But if I see price action getting back down, let's say Asia, London, or around the New York Open, right? And if it can be sustained around these levels, let's say for NQ, or around these levels for ES, and same for the Dow, it would be kind of the same. So filling in this thin move where there was no volume put in and maintaining the current market structure, at that point I might say, you know what, we might have a bit more to bounce starting out the week. All right. If that doesn't happen, therefore, let's say you come back down, you fail at maintaining these levels, and you get back into the previous range, at that point, your assessment, or at least mine, I can't, I can't talk for yourself, right? But my assessment would be, okay, you know what? I might have to take it as for the bounce was quickly faded, and the most bullish thing I would expect, again, intraday, I'm just talking intraday, not talking at the end of the week or the rest of the month. It might be getting back into the range and choppy around into the range. If we chop around into the range, at that point, I need to remember the relative strength. So I'd say we chop around in the range, and if we start to show intention to go to the downside, I would take my shorts on NQ because of the relative strength, and I wouldn't try to short a yes because it's currently relatively stronger. So again, those are all tiny pieces that you can try to put together in order to have a little bit of a guidance throughout the week. Okay, it doesn't mean that you know already what you're going to do, but at least you're setting up scenarios by which every time price goes ahead and every time price it's breaking a level, it's holding a level, it's bouncing off of a level, it's breaking down, retesting the level from the other side and confirming a flip. You always have some sort of a map which is telling you what the odds might be of, scenario A happening over scenario B. So I would do that. And if I had to bet on the downside move, uh, I taking out the previous weekly low, I would bet on NQ. Secondly, I would bet on ES. At the very least, I would bet on the Dow. This is just short term. Again, I want to stress that enough. This is just short term. As I said, when we started out with this chart right here, right? If you zoom out enough, the Dow, it's not strong, or it's not stronger than the Qs or than SPY over the long period of time. But short-term fluctuations for now and getting into Monday, I'd say this is my relative strength type of matrix, if you want to call it that. And I know now I said matrix, and everyone is going to call me up on that. Yeah, so be it. Look, the thing for me is that you know, beyond the volatility, the VIX spiking, beyond the market being particularly extended, beyond a possible try to pull into this moving average cross, or uh, avoiding them to cross like it was in the past. There is also another thing. ES is relatively stronger right now, okay? And I think if you check, let me see if I got that. Should have it right here. Let me check. If you check these and if you look at these sectors, for the last 5 days, what you see is that what was hit the most was technology, utilities, consumer discretionary services. But there are other sectors like financials, or if you check staples, or healthcare, and even real estate. Like, this is not a broad dump. It's not like everything is crashing down as for technology. All right. So I think we can retain a bit of hope to see a decent bounce, or at least the market being a little bit stubborn to keep on going down, because I'm not seeing. Look, if you think the market it's really throwing in the towel, they would sell everything. All right, they would sell everything. Of course, I mean, they would start from what is much more volatile, what is much more expensive, and in this case, the narrative fits, of course, technology, right? But if there was a systemic event or a liquidity event, investors and traders alike, they would be liquidating everything, all right? So I think there is an opportunity for looking at this dynamic I was talking about right here, seeing if we can hold this range high now, and try to see if early on Monday, Tuesday, we can put together or sustaining these bounds. That would be my assessment for it. And after that, it all comes down to see how high it will bounce and what's going to happen at a point throughout the week. Just remember, among other things, next week, we are going to have another week full of news. So PMI out of the US. And on Friday, we're going to have NFP and unemployment data. So be ready for another volatile week. Okay. So furthermore, to stress a bit more was what I was trying to communicate with this thing about not being a so generalized dump. You can check the sectors, right? So same as we were looking at right here, you can see that the different sectors, they got an acronym, right? So they got a particular chart that you can check. So this is the technology sector. You see how beat up it is, right? It's beaten up, right? So down almost 6% this week. And I just measured the most bearish close. But if you extend it, the lower point was almost 7%, right? But just to give a broad idea of the dump. Then if you check consumer discretionary, again, down 3.25%. Communication, down 3%. And then you got materials. And you start to see they held up a bit better. Then you go and check the financials. Financials are laughing. They're about to break up again to the upside. They're breaking out, or at least so it seems. So you see that? You see healthcare doesn't look bearish to me at the very moment, at this current moment in time. You check consumer staples. which again, these are very defensive type of sectors, right? Staples, healthcare, financials, and even real estate to some degree. So the market is not completely melting. Just be very aware of that, okay? It might help you a lot in understanding where the index might go or might not go, or where the odds are. So ultimately, if you think to wake up on a Monday morning, placing your short, coming back at the end of the day and collecting the money, I think you might get another thing coming. So take your time, just let it play out, let the market tell what it's going to be. And then, if you see that this scenario you were anticipating is playing out, then you got a green light to go and trade. If you see it kind of unfolding itself, and at the very last moment, for example, it just fails, then you got very high conviction in trading in the opposite direction of what was anticipated. If you see a pattern unfolding itself and it fails at the very last moment, I don't know about you, but at least that's where I really like to go in with conviction. And in this case, would be shorting every single rally I can find intraday, if that scenario fails. So in this case, would be market opens up, gets back near the lows, tries to hold it, and then it shits itself, right? Instead, if you see the market opening up, coming back down, holding around the previous daily low, and trying to accumulate, that's when you know what, we can't really go down. So maybe we should prepare ourselves to be long this market. Where to? I don't know, a previous daily high or the middle of the range or the moving averages. You pick your target. But I hope it's clear enough. It's a little bit of a framework to what you might want to do getting into next week. Overall, this close that we got, this move to the upside, which was particularly substantial, especially on ES, I think a lot of it is short closing. Those are just shorts which are taking their profits, getting into the weekend because they don't want to wake up on a Monday morning and see maybe the market, I don't know, having a massive bounce, and they could have locked in a lot of profits and they didn't. Again, why it could be short closing? I just checked this one. I checked the print on the volume profile. And when you see it moving it like this, especially at the very last hour of the day, I think those are shorts which have been closed quickly, getting into the close. You could, I mean, if you have something which tells you about positioning, I'm not talking the commitment of traders because that actually comes out every 2 weeks, if I remember correctly, but that would be my read. I might be totally wrong. Again, just because you have a framework, it doesn't mean that it's going to be correct 100% of the time. But at least you have something to go off of. And if it fails, again, just because something fails, just because the market doesn't move the way you were anticipating, it doesn't mean that it's not giving you new price information. And it doesn't mean that you don't have a setup or you don't have a new idea, right? So try to start out with an idea and then look how it unfolds itself, and then you decide what it might be and how you should act upon it, right? So uh, I don't think there's a hell of a lot more as for stocks, so we might just end up the stock chapter, just one, and transition into bonds and yields so that we can close down the weekly recap. All right, so let's move on. So as for the bonds, let's just check what they did on the chart ahead of first and foremost. So the yields, they kept on coming down basically throughout all the week, just down and down and down. I mean, This played out exactly how we were expecting it to play out. And if you check the ETFs on the bonds, so the TLT and the others, you remember we were talking about a sharp move to be sustained and getting back into these levels. Now, here it might get a bit tricky. So you might have potential resistance at this level, at least on first pass. Now, the problem is if you were just looking at these chart on the left alone, that would be a fair assessment to me. And considering the overall trend, this is one place where if it was any other chart, I would take profit. Probably I'm gonna be. But if you check the others in comparison, it looks like on the medium end of the curve, we are already past that level, or this tiny top, or this tiny redistribution, okay? And if you check the 2 years, right, that should be it. So again, we are already past it like a lot. And moreover, we broke another high right here. And we are now trading even above these farther shelf. We basically got back into previous levels of resistance. I get it. But the thing is for me, bonds tend to be a bit tricky sometimes because they transition from these periods of choppiness and then they got these, it might be 10 days or a bit more than 10 days of a sharp movement on one direction only. um the safe way to approach it for me would be to de-risk a little bit just in case around these levels and then see what happens, especially because I mean especially if you are very well positioned right from very lower levels. But I think at a point, as for any other thing in markets, they don't go in a straight line, and you might have a bit of a pullback. So to the upside, if you're looking at the yields, to the downside, if you're looking at the actual treasuries. For now, I would still thinking the fundamental thesis I got, it's playing out. You know, you could argue if it's playing out faster, quicker, or slower. I'm only interested in the fact it's playing out. And by looking at all the metrics we were monitoring throughout these months, as for the uh, hourly wages, the hours worked, CPI, PCE, the shelter component, the rent index, the, what was the other? There are many different things, but again, all across the board, I'm looking at signs of disinflation being persistent, even though the CPI, the headline, might not pick that up yet, but I think it will. So to me, I think I'm just going to stick to it for a bit longer, and of course, as always, ready for a sharp pullback here and there. But up until the point the trend is a trend, I think we are good for now. Um, just the problem is to some degree that it just takes a piece of news. It's kind of like in oil, right? Takes a piece of news, and these yields are going to go high wire. So I'm always open to the possibility that we might have a very sharp pullback to the upside in yields and a little bit of a dump into the bonds. But the entire economic framework for me is a little bit on the disinflationary side. Uh, Not really deflationary, but disinflationary at least. So that's what I would say. Also, on the fundamental side, to end up the video, I don't know if you have checked the infamous esoteric curves as for the yield curves, right? I'm just gonna check them out a little bit. Now, if you check the 2s and 10s, so the 2 year and the 10 year, they are still uninverted, which fine at this point they have been for a while now, okay? But they are not particularly good at timing when the proverbial shit will hit the fan. what could be a bit more of a timer or a better timer for it, it might be the 10-year and the 3 months calendar spread. But again, even this one, I mean, I think it's a bit better because, of course, 3 month it's a much smaller time period than the 2 years. But again, maybe not enough. I guess it's a bit closer, but maybe not enough. So I remember I recorded a video which I never published because it was really too long. It was all about inflation, oil, the oil market, and the economy and whatnot. But I was touching back then on what is the favorite tool that the Fed uses to grasp these type of triggers for economic recessions. And they do like a lot the near term forward spread. Now, I I'm sure I'm gonna butcher the definition of it, so just in case I'm gonna try to put it on the screen. But if my memory serves me correctly, I think that is basically the current 3 month Treasury bill yield minus the 18 months forward same 3 month Treasury bill yield. So what do I mean is you take the current yield on a 3 month Treasury, then you take what the market is pricing in for the same duration, but 12 months in the future. So I guess you should look at the futures market, right? It is just the difference in between these two. What's interesting about it, historically at least, is that if you check it out and if you check the what was that the 90 days moving average as for this type of curve, you will see that it was a very good timer as for calling recessions. So even this one, it might be that it inverts, it uninverts, but in the Fed speech or in the Fed words, it's the 90 days moving average, the one which is really giving you the clue. I mean, and if you check a chart, you will see that, you know, over the last 35 years, it was a good timer. So I guess I got one. Let's see if I can put it on the screen. Okay. So I think, yeah, I'll put it just when I edited that. But um, the the moving average should be the red line in this case, and the shaded areas, as usual, are the recessions. So yeah, I mean the curve itself, it can bounce around the inversion or uninversion type of level, the zero level, but the moving average is what really gives you the clue. So when that crosses to the upside, that's usually when you really got the shit hitting the fan. And again, this is what the Fed itself is actually communicating. You can check on their own website if you want to. They are actually defining it as a less distorted mirror, so to speak. So they are admitting that they find much more clarity into it. Then again, do you want to trust the Fed on this one? Don't you want to trust them? It's hard to trust them, but I mean, if you check the charts, uh, they speak for themselves. Just to play devil advocate a little minute, people have been talking about the yield curve for a long time, especially around 2022, 2023, and many different folks were saying it's broken. It doesn't have the same type of uh, predictable capability it used to have in the past. Uh, Look, I might agree with that in the sense that the periods by which it was actually calling a recession, the average was, I think, 12, no, sorry, 18 months was the maximum, 18 months or something like it. And we've seen that recently that period actually extended a lot. And of course, until we don't have a recession, it's still extending. But again, I think what people don't appreciate enough is that the yield curve inversion in and of itself, it's not meant to be just a recession call, okay? But it tells you a lot when it comes down to the perceived risk in the market. Because just think about what's happening there. Why? I mean, the normal condition of a yield curve should be seeing the curve steepen. All right, so short-term rates should be lower compared to long-term rates. And why is that? Well, look, simple example. If you have to lend me money, what do you think you would charge me as for the rate, the yield you would like to have on your loan, right? If you lend me money for 6 months, let's say you would charge me like, I don't know, 2%, just random numbers. If I would ask you money for 10 years instead than 6 months, would you charge me more? Would you ask more than 2% or less? You would ask more because your money would be with me for much more, much more time, much longer period of time. So you would need to account for the duration risk you are taking when you extend that loan out to me, and you want to be compensated for that. You know, even being completely absurd. If you lend me money for 10 years, just the potential risk that I die, I can give you back the money is a risk you need to take into account. While instead, if you give me money, but we do agree that I'm gonna give them back to you in 6 months, the chances that I'm gonna die over the next 6 months instead of the next 10 years are much smaller, right? So again, that there is this risk that needs to be factored in. So that is the normal condition the yield curve should have. So why would you think that at a point long-term rates should be lower than short-term rates? It's completely the opposite of what you would expect. And the answer is the risk perception, in my view, because people say it doesn't make sense. Nobody would accept to lend you money for a much longer period of time, but asking you a lower return. Yeah, exactly. So if it doesn't make sense, but nonetheless yields are trading this way, what does it tell you? It tells you that all these huge financial players, that they could be shadow banks, they could be international banks, commercial banks, big financial institutions, insurance, whatever you, they do prefer to buy the long end of the curve, okay, rather than lending money out in the real economy, because they look around and they feel like the economy is a little bit of a shithole. And if they lend money to a private entity, i.e., a company or a business, they are taking on too much risk. And it's not about the risk reward ratio, because one might say, okay, then they are just charge a higher yield on the loan. No, they're actually thinking about getting their money back. They're not only thinking about how much money they can make on the loan. They are not thinking about the return on capital. They are much more worried about the return of capital, which is why they do prefer to buy the treasuries, because they do know that at least in nominal terms, they are not going to go bust. The US government, it's going to pay down those money to them. They're going to be covered in full. Because why? Well, because the government has the printing press, right? They just need to click a button and they got the dollars. You can't. A private entity just can't. So, which is why, even if it doesn't make a lot of sense, in terms of the risk-adjusted return, or even if you factor in inflation, you might say that bonds are a free return risk. Yeah, whatever. But you need to understand, if it doesn't make sense under a lot of different perspectives, why then it's happening? And the answer, again, it's risk perception. And of course, that has implications, because if the perceived risk goes up, what do you think is going to happen to currency circulation or credit extension? It's going to go down. If credit creation goes down, it means new money are not created and they're not flowing into the economy. If new money, therefore credit, it's not flowing into the economy is going to be starved of liquidity and credit. And what you get? A liquidity issue. If you got a liquidity issue, what's going to happen to markets? So it's really what you should appreciate about the yield curve being inverted. All right. It's not about, oh, it's inverted now, we're going to have a recession tomorrow. No. Again, if you check a chart randomly about yield curve inversion, you see that, first of all, the real shit is hitting the fan when the yields, the curve is actually uninverting. And secondly, not all the curves are created equal. Okay, so I just wanted to touch a bit on that because I think that there is not enough appreciation for it. Lastly, since we are still looking at these yields and you see the 2 years, which is really plunging, look, we have briefly touched last week on the fact that the Fed is setting up the or at least it has a large, very large influence on short-term rates. And I'm gonna need to bring it on the screen this time because I want to be able to zoom in. Now, if you tell me the Fed is in control of the short end of the curve, then you're going to have to explain me this. Now, Fed funds is in blue. The 2 year yield is in red. Maybe I'm wrong, but what do I see here? We are starting from the late 80s, beginning of the 90s. What do I see here? They are both going up. Then the 2 years goes down. Oh, Fed funds follows. All right, and you got the recession at the beginning of the 90s. All right, then they both stays down. Fed funds is down. The 2 years is down. Check this out. The 2 years is starting to make higher lows, and eventually it goes. Fed funds, it's following. All right, what happens next? Oh, the 2 year is peaking up, topping out right here. Oh, Fed funds is still going up, and then now it goes down. And again, bear in mind, we are talking weeks, if not months, in the lag in between the two, right? Don't be misled by the fact that we are zooming in, but if you check the timeline below it, you can appreciate that, okay? I mean, again, going ahead, what happens in the 2000s? Look, the 2 years yield, it plunges. Fed funds stay stable for what? Another few months before actually catching up with what the bond market is actually dictating. All right. And then look, after the dot-com bust, the 2 year yield, it goes for a higher low. Fed funds, a lower low. And then here, the 2 years really starts to go up. And a few weeks later on, the Fed is actually raising rates. Okay. Again, 2 years topping out, Fed funds staying stable, higher for longer narrative. 2 years plunges, the Fed drops. And it was 2007, 2008. And even after that, it took a lot to recover from that. But who started to recover first? It looks to me like this red line right here is starting to climb to the upside here, while Fed funds is staying flat. So again, one more time. 2018, 2019. This is recent. Was what? The Trump tariffs and whatnot. Trade war, what was that? Look, 2 years yield, it's topping out. Few months back, the Fed drops. And if you remember the fight in between Trump and Powell, Trump was demanding lower rates and all that funny shit. So again, and recently, last iteration, the 2 years plunges, goes for new lows. If this was just a normal asset, we will be talking about a break in market structure, fail at new highs, break market structure here, break the trend line, break the last dip swing low, and it goes for a downtrend. Fed funds, higher for longer. Yeah, I mean, inflation risk. No, we need to drop. So again, what are we seeing now? Oh, the 2 year, it's really going down. So again, when you see, even on the Fed Watch tool, if you start to go through the different expirations, so to speak, they're not pricing in cuts. I guess the first legit chance of Fed funds being cut, it's priced in for September 2025. I, I don't know. Everything. It could be everything. I do think one way or the other, and I don't know what the catalyst might be, but I think at a point the Fed will find out that they are way behind the curve and they will need to cut, and that and we are not going to end up having two cuts in 2025. And I think the first, it's not going to be in September. Do you want to play the game? I think we might have the first cut around June, July. All right, so now we can timestamp that, and next time you, maybe in 6 months, you would be able to call me a dumb fuck if you want. All right. So again, just a little bit of a rant against the Fed one way or the other. But that is all, folks. So have a good rest of your weekend. Have a good Sunday, and as usual, remember what I said about next week. The initial stage of the week, just try to identify what's going to happen in the stock market, right? And we'll see how it goes. We're going to find out next week. Okay? Be nice and be cool. Neil's out.
Shit, this is really gonna affect people.
Yeah, it's going to affect people like me.
Well, real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. People want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. The funny thing is, tomorrow if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, well then the same people are gonna laugh till they piss their pants, because we're gonna look like the biggest pussies God ever let through the door.